Welcome back to the week that was. If we had to sort of slap a title on the market action over the past few days, I think we'd call it the battle between fear and fundamentals.
That sounds about right.
Yeah,
Yeah, we saw this clear conflict playing out.
definitely. Despite what felt like a pretty fragile technical structure, short-term anyway, and, well, undeniable extreme fear in the market, the long-term kind of foundational bullish case for digital assets actually got quite a bit stronger. We saw moves in multiple global arenas.
It really was a stress test, wasn't it?
Yeah.
For the market and, for you, the investor watching all this unfold, Bitcoin spent a lot of the week fighting to get back above that critical psychological level, $110,000.
Right. After bouncing pretty hard off those lows, we saw, what was it, $104,000, $105,000 range?
Exactly. But this conflict is not just about hitting certain price points, is it?
No, not at all. It's more about, like, sentiment versus structure. Our sources were showing the Crypto Fear and Greed Index hitting readings down around 22 to 25. That's deep in extreme fear territory.
Deeply entrenched, yeah.
Yeah. And that kind of panic, it often drives the near-term price, right? But it was happening at the exact same time as this, well, explosion almost of institutional adoption catalysts around the world.
That's the core tension.
Yeah.
You've got raw fear clashing with these powerful structural shifts.
So we need to try and reconcile those two things, make sense of it.
Exactly. Maybe let's start with the technical side, because that short-term volatility, that's often where the patient money starts to make its moves.
Okay, good idea. So looking at the charts, the immediate stability, it really seemed to hang on defending one very specific zone. Where did the analysis put that vital defense line?
Yeah, the absolutely crucial floor for keeping that recovery narrative alive was right between $107,000 and $107,600.
Okay.
And that range, it wasn't just plucked out of thin air. It included the 200-day moving average.
Ah, the 200-day. Always important.
Always. It's a level that, the big funds, the algorithmic traders, they treat it as a really definitive line. Sort of the difference between a sustainable uptrend and a much deeper correction. Losing that would have been bad news.
Would have signaled real systemic weakness, probably. And yet, we held it, we bounced. What actually drove that first push off the lows? Was it like fundamental buyers stepping in, or was it more technical?
It felt primarily technical, at least initially. We saw this massive liquidation signal report showed over $300 million in short positions got forced to close.
Wow, $300 million.
Yeah. And when short sellers have to buy back quickly like that, it just creates this powerful upward vacuum in price. So you had that technical squeeze.
Right.
And it combined with, easing macro sentiment. The probability of a Fed rate cut jumped up near, almost 99%. That combination provided the fuel needed for the bounce.
Okay, but here's where, for me, the on-chain stuff gets really interesting. It kind of reveals the story underneath the price action. We need to talk about that transfer of wealth that seemed to be happening. The stress looked really concentrated on the newer buyers, didn't it?
Oh, absolutely. We saw really classic capitulation behavior among the short-term holders, or STHs. Those are the wallets that held coins for less than about 155 days.
The freshman investors, basically.
That's a good way to put it, yeah.
Yeah.
And two key things happened with them.
Okay, what were they?
First, the STH SOPR, that's the spent output profit ratio for short-term holders, it fell below 1. Plain English. They were selling their coins, on average, for less than they paid for them, taking a loss.
Ouch.
Yeah. And second, maybe even more importantly, the STH NUPL net unrealized profit loss showed it. This whole group, collectively, is now holding an unrealized loss.
So they bought higher, the price dropped, and now they're sitting in the red.
Exactly. Think of it like a bit of a stampede, or at least the pressure building for one.
Yeah.
These are the folks who bought relatively recently. They're feeling the pain, and that often leads to forced selling, just trying to get out.
And that fear-driven selling, it creates this continuous supply hitting the market. But hang on, the reports also said long-term holders, the LTHs, were also distributing. They sold, a net 28,000 Bitcoin since mid-month? No, wait. If the supposedly patient LTHs are selling, isn't that a sign of worry? Even if the short-term guys are panicking.
That is a really critical question to ask. LTH distribution isn't always driven by fear, though. Often, it's smart profit-taking. These are coins acquired at much, much lower prices.
Right, realizing gains.
Exactly. They're creating what the analysts call a supply headwind, just a steady flow of coins coming onto exchanges. But what's crucial here is how that supply was absorbed.
Meaning,
despite both STHs capitulating and LTHs taking profit, the price didn't just completely collapse. It found support. That proves there's substantial patient demand on the other side waiting to buy those dips.
Okay, that makes sense. Someone is buying what they're selling.
Precisely. And all this tension, this push and pull, it's happening right before a guaranteed injection of volatility. We're looking at a record, I think it's $31 billion in Bitcoin options contracts set to expire very soon.
31 billion, that's huge.
It's massive. And there's apparently a high concentration of put options that's the price will fall, clustered near $100,000. So the market structure is just perfectly coiled. It could snap either way. A massive short squeeze higher, or maybe a final decisive move lower.
Definitely something to watch. Okay, so while the tactical traders are busy navigating that messy technical picture, the long-term sort of structural integrity of this whole asset class got a massive boost this week, didn't it? Starting with a really pivotal moment overseas.
Yes, the UK leapfrog, as some called it, the Financial Conduct Authority, the FCA, they lifted their 4-year ban on retail access to crypto exchange-traded notes, ETNs.
Which is huge in itself, but like you said earlier, it's the reaction that was really telling.
Oh, it completely redefined the competitive landscape almost overnight. Big issuers. We're talking BlackRock, Bitwise, 21 Shares, WisdomTree. They didn't just dip a toe in. They immediately launched ETPs on the London Stock Exchange.
No messing around.
Zero messing around. And it wasn't a cautious entry. It instantly kicked off an aggressive fee war.
Right, I saw that Bitwise specifically slashed its total expense ratio, the TER, down to, what was it, 0.05%.
An unbelievably low 0.05%. That fee compression tells you so much about how essential this asset class is now seen by the global financial heavyweights.
How so?
Well, think about it. This isn't just a low fee. It means the UK market basically started at the end stage of institutional maturity for fees, instead of, years of high-fee products gradually coming down.
Yeah, the usual slow adoption curve.
They jumped straight to the most competitive pricing model you see anywhere globally. It basically forced providers to undercut each other from day one. Huge signal.
Meanwhile, back in the U.S., the spot ETF flows, which we watch as the sort of ultimate institutional barometer, they gave us a bit of whiplash this week.
They really did. We started the week with 4 straight days of net outflows. Looked like institutions were maybe getting a bit cautious. That included a notable $100.7 million withdrawal from BlackRock's IB.
Yeah, I saw that figure. Raised some eyebrows.
It did. But then came this decisive, almost validating reversal. The data showed a massive $477.2 million net inflow for a single day.
Wow, nearly $500 million in one day.
Right. This wasn't gradual. It felt like institutions confirming their conviction. Like, okay, brief pause, now we're back in. And in a big, concentrated way.
And what's really fascinating there is the potential capital rotation story. That big ETF inflow, it coincided almost perfectly with I think it was a 5.9% drop in spot gold prices.
That correlation was hard to miss.
It strongly suggests, doesn't it, that institutional investors might be actively moving store value capital, taking it out of traditional gold instruments and putting it directly into Bitcoin.
Treating them as substitutes, essentially, which is a major narrative shift.
Definitely. And we can actually get a glimpse of who might be doing the buying thanks to CryptoQuant's dolphin thesis.
Ah, yes, the dolphins. They track wallets holding between 100 and 1,000 BTC. It's used as a proxy for, sophisticated large institutions, big family offices, that kind of player.
And what are the dolphins doing?
They're accumulating significantly. This group now controls an impressive 26% of the total circulating supply. And get this, they've added a net 681,000 BTC just this year alone.
681,000 Bitcoin. Just that cohort.
Just that cohort. They are acting as the primary source of that patient demand we talked about. They're the ones absorbing the supply coming from the fearful short-term sellers.
So it really validates that idea, doesn't it? You've got two very different groups of investors operating in almost two different realities right now.
Perfectly put. And that institutional maturing, it's not just ETFs. It extends right into corporate treasuries.
Right. We saw Strategy Inc. bought another 168 BTC for about $18.8 million, just adding to their stack, reinforcing that public strategy.
And we're seeing other companies like Hyperscale Data, Inc., building it right into their core capital strategy. They're aiming for $100 million in digital assets using dollar cost averaging.
So it's becoming like standard financial engineering for corporates now.
Exactly. And you even see the infrastructure maturing around it, like the creation of these Bitcoin treasuries as a service platforms. It's all becoming more formalized, more integrated.
Okay, so if the market's going to really shake off that short-term fear for good, it needs long-term de-risking. And it feels like this past week, The U.S. regulatory picture moved from being kind of ambiguous to actively clarifying things, accelerating that process.
Absolutely. The moves from the Federal Reserve, I think, were arguably the single biggest structural de-risking event we saw. At their Payments Innovation Conference, Governor Waller introduced this framework for skinny master accounts.
Okay, skinny master accounts. Why is giving institutions like fintechs, stablecoin issuers, direct access to the Fed's payment rails so critical? Why does bypassing those smaller, crypto-friendly banks matter so much?
Yeah. It's all about removing centralized risk, removing single points of failure. Historically, stablecoin issuers, for example, they had to rely on just a handful of specialized, often smaller banks to get access to the Fed system.
Right, the Silvergates, the signatures.
Exactly. And if those banks get into trouble, which, as we know, has happened, the whole stablecoin ecosystem, and by extension the wider crypto market, faces this huge systemic shock.
Okay.
This skinny master account proposal, it aims to integrate that stablecoin infrastructure directly into the secure core plumbing of the U.S. financial system. It dramatically reduces that catastrophic risk profile. It's huge.
Wow, okay. That is a big deal. And if you connect that sort of monumental step from the Fed to what's happening on the legislative side,
Yeah.
you see this kind of harmonized push for clarity, right? The Digital Asset Market Clarity Act. The Clarity Act seems to be moving forward,
Designed specifically to end regulation by enforcement.
which has been the big complaint for years.
Exactly. The key goal of the Clarity Act is to draw a clear jurisdictional bright line. Think of it like setting up clearly marked lanes on the regulatory highway.
Okay.
The idea is to give the CFTC oversight of the spot digital commodity markets,
Right.
the day-to-day trading of Bitcoin, Ether, etc., and then confine the SEC's role just to overseeing the initial token issuance, like an IPO.
So it basically stops the SEC from trying to regulate tokens that are clearly trading like commodities after they've been issued. That's been the source of so many legal fights.
Precisely. It aims to establish a stable, predictable referee for the spot market. It ends the threat of, retrospective enforcement actions years down the line and lets businesses operate within known legal boundaries.
And the administration's intent seems pretty clear, too, with President Trump nominating Michael Selig to chair the CFTC. He's known to be pretty pro-innovation, and he actually served as counsel on the SEC's own crypto task force.
Yeah, his background seems perfectly suited to try and harmonize these efforts across the different agencies, bridge those gaps.
And it's not just regulation. We're seeing traditional finance actually embedding crypto deeper into their core businesses now, too. JP Morgan Chase, reports say, is getting ready to allow clients to use Bitcoin and Ethereum as actual collateral for loans.
That is profound. Think about what that means. It treats these digital assets not just as something speculative you hold over here,
Right, not just an investment.
but as productive collateral.
Yeah.
Assets worthy of being used in the core lending functions of one of the biggest banks in the world, right within the legacy system. That's deep integration.
Okay, so huge fundamental strengthening, regulatory clarity improving. But the market still had to deal with some classic macro turbulence, didn't it? We had that geopolitical whiplash midweek, President Trump threatening tariffs up to 155% on Chinese goods.
Yeah, that immediately created a risk-off feeling. Selling pressure came in across the board.
But geopolitics moves fast, as you said.
It certainly does. By the end of the week, that whole tone reversed pretty sharply. High-level U.S.-China trade talks resumed, described as very constructive. And just like that, the geopolitical tail risk seemed to reduce, offering a catalyst for risk assets, including crypto, to rally again.
We also finally got the delayed U.S. CPI data. Did that move the needle on rate cut expectations?
It did, yeah. The data came in just slightly cooler than the 3.1% forecast everyone was watching. It registered at 3.0%.
Okay, so marginally better.
Marginally better, but enough. That modest reading immediately increased expectations that the Fed might cut rates sooner rather than later. That feeds liquidity hopes back into risk assets, and it definitely helped fuel that short-term rally we saw back towards $111,000.
Got it. Okay, finally, let's touch on one of the most, I think, interesting structural shifts we saw highlighted in the source material this week. The strategic pivot happening in the Bitcoin mining sector.
Ah, yes. The decoupling.
Exactly. Analysis, including reports from places like JP Morgan, suggests mining stocks are starting to decouple from Bitcoin's actual price performance.
It's a signal of a really profound business model transformation that's underway. Miners are realizing they have these huge assets, massive data centers, often in remote locations, crucially with access to cheap, sometimes stranded power.
Right, their core infrastructure.
Exactly. and they're pivoting strategically to leverage that infrastructure for the high-profit artificial intelligence and high-performance computing HPC market.
Why are they uniquely suited for AI compute?
Well, they already have the hardest parts figured out: securing massive power contracts, building out efficient cooling solutions, the expertise in managing large-scale data centers incredibly efficiently.
Okay.
By using that capacity to provide HPC services for things like AI model training and inference tasks that need stable, cheap power 24/7 too, they completely transform their business model.
So they're not just pure Bitcoin price plays anymore.
Not at all. They're becoming diversified digital infrastructure companies. Their valuation gets increasingly linked to the high-growth AI sector, not just the day-to-day volatility of Bitcoin's spot price. It's a really smart evolution.
Fascinating. Okay, so let's try and synthesize all this. What does it all mean when you put the week's conflicting signals together?
It means, I think, that the market is living in two realities right now. You've got the short term, which is defined by technical consolidation, that extreme retail fear we talked about, the STH is holding unrealized losses, and that looming derivatives volatility bomb.
For choppy and nervous reality.
Exactly. But then you have the long term, where the underlying structural framework is just getting exponentially stronger week by week. You've got massive institutional accumulation, those dolphins now controlling over a quarter of the supply, patiently soaking up all that short-term fearful selling pressure.
So the message for you, the listener, is kind of bifurcated then.
I think so. If you're a tactical trader, you absolutely have to respect the volatility, especially around that, say, 107K to 113K range. It's choppy waters.
Right.
But if you're a long-term investor, you should probably view any price weakness that's driven by these short-term factors, by fear and liquidations, as potential strategic accumulation opportunities.
Because the bigger picture is improving.
Right. The corporate conviction, the institutional conviction, it's all being validated by this steady regulatory de-risking.
Yeah.
That's moving the whole asset class forward, kind of regardless of the daily price noise.
Yeah.
Remember, institutional bullish sentiment is still extremely high, reportedly near 67%.
So the market is clearly navigating this classic wall of worry, which leads us to our final thought for you this week. If the Clarity Act passes, and if the Federal Reserve's proposal for direct integration, those skinny master accounts, actually happens, if they successfully create a truly stable, regulated foundation for digital assets in the U.S., effectively removing those major structural risks,
Yeah.
will the extreme fear and the short-term holder capitulation, all that pain we saw this week, will it look, in retrospect, like maybe the final perfect entry point before the next major surge? Something for you to ponder this week.